Welcome, everyone. We're back again, Kevin and I, with another episode of Financial 15, the show where we try to improve your finances, dive into a topic, give you a little more knowledge, do all that in 15 minutes or less. Today, we're going back to how to save money in retirement, how to save tax, and we're going through the medical expense tax credit. Lots of information. You want to stick around.
Yes, for those of you that thought we were dealing with a new tech sort of scenario with the METC, no, we are dealing with the medical expense tax credit and how that's going to save you tax in retirement. Remember, if you want to see more videos along this line, anything else, please go to our YouTube channel and subscribe. Or if you can, like us on Facebook. And most importantly, visit our website. We have all this content and much, much more on there. But today we are dealing with another portion of our saving taxes in retirement, and we are dealing with the medical expense tax credit. Clint, what exactly are we dealing with when we talk about this?
Yeah, that is quite the acronym, MEC. I don't know if that would roll off the tongue exactly, but the medical expense tax credit, what is it? Basically, non-refundable tax credit. That's key to know. You have to use it. You can't just build them up and carry them forward forever. And like all tax credits, it can help lower your tax payable, but it can't create a refund. That's why accountants normally use the tax credits first and then the deductions after that. But medical expense tax credit falls into that category. Some of the big details here, and we'll get into those. You can pull it all up. What kind of expenses are eligible? Let's start there. What can you actually use with this tax credit, Kevin?
Yeah, and that's the big one. There's a variety of different things that are considered under this medical tax credit or expense tax credit, and it is positive that you have to know what they are. If not, your accountant will need to know these things. So one of the things as we go, you can go to the CRA website, and they will give you a complete list of eligible and non-eligible expenses that support this. But some of the most common ones are your medical insurance premium. So if you have a benefits plan and you pay into that, those are medical insurance premiums that can count. Prescriptions not covered by the insurance. So if they pay a certain portion and you pay the rest of it, that is eligible. We deal with sort of things like nursing home expenses. And again, this one's got to be clarified because if you're in a nursing home, it's not all strictly medical that you're paying for rent as well, but only the medical portion is basically what we're looking at. Portion may be rent and medical, but we're looking at that's the sort of home expenses. Chiropractor, glasses, hearing aids, all make sense. And then if you have to travel for medical purposes, there is the 40-kilometer medical service, 80-kilometer medical service to claim meals as well. Detailed and simple. Clint, what are we talking about by detailed and simple method?
Yeah, you can keep all your own receipts. Let's say you're traveling somewhere and you're keeping all the gas receipts. Well, that'd be the detailed method. You're going to write off exactly what it was. If you don't want to bother with that, the government has what they call a simple method, where it's just a flat rate. So many kilometers, this is the rate per kilometer, or you had so many meals, this rate per meal, and then it's a flat rate, which we call the simple method. Or you could do all the number crunching yourself and keep your receipts. Why not do both and then just take the higher one? You're certainly allowed to do that.
Yeah.
But that's what's eligible. At the outset, this is not an exhaustive list. You want to chat with your accountant, want to go to the CRA website, make sure you know what you can claim, what you can't claim. You can also claim, and we're just mentioning this here, not going to get into the details, just mentioning if you go out of province or out of country, it's possible those medical expenses could also be eligible for this tax credit, but you're going to have to provide proof, explain why you went out of province to receive medical service. And also to make things more fun and more complicated, the eligibility does vary by province. There's actually two tax credits, which we'll get into. There's the federal one, then there's a provincial component, and each province has slightly different rules. So it's not as if it's universal for that provincial bit. It will vary by province. You have to keep that in mind. So we know it's eligible. We know we can write some stuff off, use it for the tax credit. How long can we do this? What is the time period, Kevin?
Well, yeah, and that's a big factor is what's your time period? Most people look at taxes and they look at sort of January of one year to December of the end of that year. But in regard to medical expenses, it is a 12-month period. So if you decide that you want to do it from March to March, you can do that. You can do from June to June, as long as it is a 12-month period in a row. So that's the big factor that you got to know, and your medical eligible expenses for you, your spouse, and your dependent minor children. So that includes unclaimed expenses, possibly from the prior year. That's why I say you can deal with it from, sort of November of one year to November of this year. And that's the main thing, because they want to be able to make sure that you're claiming within that time frame the most expenses you can get. And then when we talk about the year of death, we allow you twice as much. So same sort of scenario, it's a 24-month period that you can deal with on that for the date of death scenario.
Yeah, so you can move that 12-month window around. So whatever medical expenses you have not yet claimed, you move that 12-month window within the rules there, and you can get the most you can out of it. We'll get into the threshold here because this is an important bit about how it
Yes.
works and what will ultimately determine your credit. We're not going to cover all of it right now because we have an example which I think will clarify things, but just to hit you at the high level, it's going to be the lesser of two numbers. It'll either be 3% of your net income or a flat amount. And for the federal government for 2022, that flat amount is $2,479. So either 3% of your income or that flat amount, whichever one's lower, that'll be the threshold you have to clear before these medical expenses will actually generate any kind of tax credit for you. So with that in mind, it normally makes sense for the lower income spouse to claim the tax credit because their income's lower, that threshold will be lower. You can also bundle it. So if I have medical expenses, my wife has medical expenses, we can bundle them and put them on one spouse's tax return, ideally the lower income spouse. And that is a good strategy. And then you'll see that second paragraph there. You can claim for your spouse, your common law partner, their kids, if they're over the age of 18 or if they're dependent. You can also get into siblings and grandparents and brothers, sisters, aunts, uncles, the whole bit there. You will have additional thresholds to clear if that is the case. It's not going to be all bundled into one, but just know that is certainly possible. And it varies. Of course it does, Kevin, right? We talked about the complexity of there being federal level and there being a provincial item here. So you get a credit from the federal government, and then depending where you live, you can get another little top up there from your province or territory. Let's get into a few of those details. How does that work?
Yeah, I mean, it's a fairly extensive list of who can and who can't get it claimed into your medical expenses, things along those lines. And it is to remember that, yes, the federal has one rate, but provinces are completely different. Each province tends to set their own rate as to what it is. So not only do you get the medical expense federally, but you'll also get a medical expense provincially as well. So remember that there's two that you're actually getting to claim for an expense tax credit. As we know, if you take a look at what the chart says here, basically what that rate of credit you're getting is the lowest tax rate that's there. So for federally, 15% is their lowest tax rate. That's what you're going to get off of the threshold. So if you can claim the $2,479, you're going to get 15% of that as a tax credit. When you look at each province going on their own scenario, as you can see, the numbers vary anywhere from the low end at around 4% to the high end at around 10.8%, which happens to be the province of Manitoba. So, and then again, if you look at the thresholds, same sort of scenario. Some of them are consistent with what the federal government does, and then you get them lowered down that way. And the only one we really aren't touching on is Quebec, because they have their entirely own formula, and it would take far too long to just explain everything for the one province that way.
Yeah, financial 15. We have to keep it within a certain window here, but important to know, right? So the thresholds are going to vary. The 3% of income, that bit is consistent. So it's always going to be the lower of 3% of your income or the applicable threshold, federal or whatever province or territory in which it would apply, and then you get the associated rates. Let's clarify this. Let's bring it home here so we can go through an example, and hopefully it'll help people out a little bit. We'll make the example full screen so everyone can see, and we'll go through it slowly so you can understand why we encourage people to try to put it usually on the lower income spouse, lower threshold. We'll see why. So we have Jerry and Taylor. They're married. They live in Manitoba. Combined, they have $4,000 in medical expenses in the last 12 months. So we got that 12-month window. And you can see the calculation here. And as net income first for tax purposes, this is just one spouse. We're saying, all right, what if that one spouse had $30,000, $60,000, $90,000, couple of scenarios. And then you got the MEC threshold here, which, as we talked about, will be the lower of the 3% or that flat rate. The flat rate for 2022 for the federal government is that $2,479. So you can see that across the board. And then the 3% will be at 3% of the income. So 900, 3% of 60,000, 1,800, 3% of 90,000. And you can see the lower one is the one we go with. That's the bolded one in each of the three scenarios. Now we got those 4,000 medical expenses. We're combining them. What if that spouse who claimed it had 30,000? Well, they have a lower threshold. It's only $900, which means they can actually get 3,100 of the tax credit. And you can see the calculation in each case. This is federal, so that federal tax credit's 15%. So you can see the net result. And the difference by income, 30,465 from the feds. If you had 90,000 of income, you're only getting 228. So that's a pretty big difference.
Yes.
Same calculation for the province. And this is the Manitoba numbers. I won't go through all three scenarios. The difference is really in the thresholds. They just have different thresholds, and then they have a different tax credit. Each province will be different, but you can still see that same general philosophy applies where the lower income will get more, and you combine them. federal and provincial. Now you're almost at $800 if someone had 30,000 in this example versus 473 if the person that claimed it had 90,000. So it's a pretty big difference there, Kevin.
Yeah, theoretically. And that's why we say, I mean, you want to look at combining the expenses, but you also want to look at why you want to use the lower income spouse. As you can see, if two spouses there and Jerry and Taylor, if Jerry earns 90 and Taylor earns 30, you definitely want to combine all your medical expenses, because what you're going to find out is that Jerry at 30 is going to earn more in tax credit that way, and that's going to help out down the road. So it's sort of the opposite of what we would do with an RSP, where the higher income is where you want to make the contributions, not on the lower side. In the tax credit scenario, we want to make sure that the lower spouse is claiming and getting the most federal tax credit and provincial tax credit that they can going forward.
Absolutely. And this is just an example. Again, there's issues with eligibility between provincial and federal, and it can get different calculations. So absolutely visit your accountant and get all the details there. But it shows you why combining and using the lower income spouse to claim often makes sense. You usually get a bigger credit and you save more in tax. So that's typically the reason why we suggest that. So lots of detail there. We went through that really quickly, the whole MEC, which I don't think that's catching on. That is definitely not rolling off the tongue. But if you have questions, if you want to get a hold of us, you can do it right down there, Kevin. Chatwithclintonandkevin.com.
Yep. Yeah, I mean, basically, that's where it is. If you want information on this or any of our other tax savings retirements, please get in touch with us. Visit our website, go to our YouTube channel. Otherwise, we just want to make sure that we're giving you the basics, the high-level stuff for this. Consulting with your accountant is always the best method for medical expenses, just to figure it all out, or CRA, and go from there. Otherwise, basically, we've done this Financial 15. We'll be on with another tax saving tip or another retirement option coming up soon. Otherwise, we are finished for today, I think. Clint, final words yours?
I think you covered it well. We'll be back again soon. Everyone stay safe. Take care.